Hey everyone, we're going to look at 12.2 now. In this video here, we've got our statement of cash flows again, very similar to 12.1. However, there are some specific changes in this problem in the way that the information is provided, specifically in that we have a listing of assets, kind of the balance sheet. Essentially here we've got assets and then we've got liabilities plus equity. We have this company, and then it tells us some information about net income, dividends paid, and proceeds from the sale of long-term investments, LTI. So if you see LTI, that's long-term investments. So the first thing I want to do when we're talking about these, the balance sheet assets and liabilities and equity, etc., is to calculate the change year to year, because that's what we've been looking at. It's just been telling us in the prior problems, or the prior problem here and in class problems, that for example, AR increased during the year, so on and so forth. But in this problem, we really have to calculate that for ourselves. So go ahead and do a formula that says take F5 minus G5, which is basically saying AR increased 173, or sorry, cash increased 173. And then we can drag this down for each one of the asset category line items. So, AR increased 105 essentially in this instance. Okay, and then you just do sum up the totals. So total assets changed, that much. Go ahead and copy that formula and just paste it over here. So then we can say AP increased by 105, or sorry, 15. Auto sum, do our summation there. Okay. So now we've got all of our changes in our balance sheet items, which is important. One thing I'll do just real quick, I wanted to show you this. So, when we have our ending cash balance, the last time it just told us what ending cash was, in our listings here in 12.1. But this is really what that is indicating, is that the cash balance that we calculate through our work should equal the cash balance on our balance sheet as the actual balance there. So let's bring that number into here. And then let's just put our, let's make our check figure now so we can just watch it and see if it goes to 0 as we do our work essentially. Okay, so now that that's set up, let's go over here and input our net income. So it told us in the instructions here that net income was 300. Now, one thing that we kind of need to figure out are some of these other items that, again, are not just specific, directly told to us. And I did do a little bit of a change in this problem because we have so many categories here. And really the way I've seen this done in practice too in the real world is you would kind of have this change in different assets section here. And so it's just going to be, change in these balance sheet items. And then we're going to put positive or negatives. The same thing. We're just not listing out increase in AR or decrease in prepaid rent. But we can see whether they're increases or decreases from our variance analysis here. Okay, so when it comes to depreciation expense, again, it doesn't tell us. We don't have a balance or an income statement in front of us to look at. So we have to do a little bit of work to figure out what depreciation expense is in this problem. And what we want to do for that is, we can look here and we don't see any sales of equipment. We see equipment went up by $30. And then we can see that accumulated depreciation went up by $25. So if we know anything about depreciation and we remember anything about depreciation expense and accumulated depreciation from prior chapters, we know that the other side of the entry, there's the accumulated depreciation contra asset increase, and then there's depreciation expense. So in other words, we can deduce that this is change since we don't have any information about sales or disposals of equipment. The fact that this accumulated depreciation change, that's going to equal our depreciation expense. And that's a non-cash expense. We add that back to net income in order to arrive at net cash from operations, just like we've done previously. We just had to kind of deduce what that was. Okay, then we have gain on sale of long-term investments. And so it tells us our proceeds from the sale of long-term investments. So we'll link to that. And then we just need to figure out what the book value of those investments were. And we can basically see right here, we didn't buy any investments. So the only activity that happened to this account, the long-term investments account, was the sale of those investments. And so we can see what the balance there was a negative. It was 135 that we sold. So that what we sold was the book value. And then again, we can do that same calculation just like we did for the gain or sale. Oh, and this one does say equipment. That should be long-term investment there. Sorry for that little typo. And so again, we received more cash than the book value at the time of sale. So therefore we had a gain on that sale. And if we had a gain, that was an increase to arrive at net income. And we need to back that out in order to arrive at the cash, the pure, cash flow from operations. All right, now we're down to the section that's going to talk to us about changes in other balance sheet accounts. So here we have AR going up. Again, remember, I kind of like to think of it when AR is going down, that means we're receiving cash. So when AR is going up, that's going to be a negative impact. And if you want to think through it really logically directly to AR, what we're saying is when AR increases, that indicates that there's a component of net income that was revenue, but it was related to AR increasing, not cash being received. And therefore, in order to arrive at just the pure cash part, we have to back out that piece that is just related to the receivables increase. But for me, I always like to think in my mind the journal entries that have cash in them specifically, which would be AR down, cash up when you're paid, and that would indicate cash increasing with an AR decrease. So if we have an AR increase, then it's the opposite. So that's how I kind of think through that situation there. Okay, prepaid rent went up, and just like with AR, it's an asset. And so that one makes sense to me too. With prepaid rent going up, remember when we pay for prepaid rent, paid for a year of rent or whatever it would be, that is a cash outlay to increase that balance of prepaid rent. And so pretty easy to deduce through logic there that is a cash reduction because we actually had to pay cash to increase prepaid rent. Inventory went down, and so inventory is an asset, so that'll just be the opposite because these other assets, we saw that there were increases there, so that those are corresponding decreases, but here we have inventory down. So it's really just kind of the opposite. And then from an AP perspective, we had accounts payable go up, and so that is going to be a positive impact. If AP was going down, that's us paying down AP, but AP is going up. So therefore, it's a positive impact on cash flow to adjust, net income to cash flow. Alternatively, all other liabilities will go kind of opposite to that. So we went negative. The unearned revenue went down, so that's going to be us paying down, or when unearned revenue goes up, that's us receiving cash. It's not like we're paying it down. I guess I shouldn't say. It's just us recognizing revenue from services performed after the fact, after we received unearned revenue cash earlier. And then taxes payable went down. This one is more us actually paying down that payable. So a negative cash flow makes sense there. Whoop, be careful your formula. Go all the way to the top. So then we get 205 net cash flow from operations. Proceeds from sale of equipment, we had that there. That's a positive inflow. Proceeds means we're receiving the cash from selling something. Purchasing takes cash, and we had plant and equipment go up by 30, and so we'll do a negative 30 there. And we're just kind of again having to use our logic to figure these things out, and that's just representative of the fact that we could see that the plant and equipment account increased, which basically we can deduce from that, if plant and equipment increased, it means we bought some new assets. It doesn't tell us we had any disposals, so the only thing that happened to this account was purchases, and therefore it went up $30 in the equipment account, and so we must have paid those $30 there, and that's a decrease in cash to pay it. Okay, dividends paid, pretty straightforward thought process there, I think. It's negative. Bonds payable being issued means that we have increases in cash related to that debt increase. Same thing with the issuances of stock. Let's see, treasury stock being issued. Now remember, and I think actually we should say treasury stock purchased. Let me fix that as opposed to issued, because we're buying back our own stock in that instance. And so, here we can just link to this. That's going to be, we had to pay to repurchase this stock, and so that's $272. And that leads us to 152 cash outflow from financing, mostly related to purchasing the treasury stock. And then let's just add up all of our cash flow category totals, our beginning cash flow here. And this is, we have to use our, just like we had ending cash balance as our check figure, our beginning cash balance will just be off of last year's ending cash balance becomes this year's current beginning. Then we add those two together, and all right, lo and behold, we get our check figure to go to 0, and we're doing good. Everything balances out, and we've got all our information accounted for. So yeah, just a different way of looking at it. You got to do a little more work. This is more realistic of a scenario when you're actually doing a cash flow statement. It's not like you have some information right in front of you necessarily. I mean, you have to figure that information out. How much did AR change? So you have to actually take the difference, as opposed to some listing of things like this in 12.1. It's more so analyzing the actual line items on the balance sheet and looking at net income and certain categories to figure out how all those components interact. So, all right. Well, thanks everybody. I will see you in the next video, and we'll work on problem